Hey guys, I'm Matt Lipton. I'm really grateful to be here today. I'm one of the emergency medicine docs, did my residency here. But I'm going to talk to you about physician finances. It's something I didn't know much about when I was a resident here. That I'm hoping that I can improve your guys' financial literacy today. But just really quickly, by show of hands, how many people like talking about money? Okay, there's some enthusiastic hands. Okay, that's pretty good. How many people are like, I just want to focus on medicine. I just want to be a doctor, and I want someone else to deal with all my money? Oh, okay. All right. There's a little bit, and that's fine. That's fine. But well, hopefully, what we'll go through today is a little bit of introduction to basic finances. We'll talk a little bit about more advanced finances, and talk about whether you need a financial advisor in your life or not. So, why am I chosen to speak today? Well, I think it's because that when I was a resident, after I finished my residency, I was like, oh man, I got to pay back my student loans. I did an ultrasound fellowship, trying to figure out how to pay back loans. And then right at 2013, 2014, there was a physician blogger coming out who was an emergency medicine doctor that I was really interested in. I liked what he wrote, and it turned out to be the White Coat Investor, if you guys are familiar with him. And so I really just gobbled up all his information. I follow his pathway a lot. So my talk is heavily influenced by the White Coat Investor. So I did that for many years. I was really into finances. I started a physician financial group about 5 years ago. So it was initially started for attendings to talk about like what to do with your money, especially like extra leftover money, which I know is kind of a weird concept right now. But then it has trickled down. I was like, I'm leaving out all the residents. So now it's basically a resident and attending group that we just meet up and usually at a brewery and talk about money. A little bit of a lecture, some discussion. So it's open to anyone. If you guys want to join, there's some stuff at the end. Of course, it's just like we meet once a quarter. So I have been giving talks to the residents, to usually emergency medicine residents and the medical students about this. So hopefully I've tailored this a little bit more to residency finances as well. Um, so without further ado, my clicker's not working. All right, so this talks to me about the high yield financial topics that I wish I would have known when I left residency, or especially medical school. It's really hard to make a lecture for all residents, and that's because I can kind of understand where like medical students are versus residents versus fellows. You're on like different levels of medical education, but like financial education is completely different in the medical field. So like some people have MBAs here. Anyone have an MBA? All right. Well, I'm sure, and then some people have like absolutely no financial knowledge. And so it's going to be a lot of, I'm sorry if some of this is a little too basic or a little too advanced. I'm trying to do it for everyone. I'm going to give you a lot of QR codes, and I'm going to give you the slides at the end. So you don't need to like write everything down if you don't want to. And finally, I wanted to take away the taboo of talking about money. A lot of my attendings when I was a resident didn't want to talk about money, or at least were, always seem to kind of not give me straightforward answers. And I want to remove that taboo and be more free. So I'll share my financial information. And of course, it's pretty informal. So feel free to stop me, interrupt me, ask questions at any time. All right. And there's a perfect time for this lecture because there's a study that just came out in the New England Journal, 20 years following residents. I'm just kidding. This is not actually a real study. Um, maybe a couple people were already trying to cross-reference this, but this is to highlight how there is a lack of financial education research in the medical field. There are studies that they have done. They're mostly from the last 5 or 10 years, and they're really bad studies. They're mostly like surveys, maybe a couple interviews with residents, maybe like a pre-post test after a lecture. I probably could have written a paper today if I would have given you guys a pre-lecture, or excuse me, a pre-test, gave you a lecture and then a post-test, could have written it up and published under, some financial literacy in medical education. So that's kind of the level that they're at. It's nothing, no groundbreaking research, but probably the best study to date is this study from the Journal of Surgical Education from last year, and they did a meta-analysis. And I know what you guys are thinking. Meta-analysis, is based on the quality of what goes in. Not the best stuff goes in, but what we have, they summarize. And I'm going to summarize the meta-analysis very quickly. And so the basics of it is saying that residents or medical students graduate and go into residency with substantial financial debt. A lack of financial literacy will result in increased debt, anxiety, job dissatisfaction, and or contribute to burnout. Okay. And improving financial education could improve those things: financial stability, emotional well-being, maybe even patient care. They kind of hint at that. That's not really well studied, but they suggest that. And so their end result of all these studies say, you know what? They conclude that medical students and residents need basic personal finance education as part of their curriculum. And so that's as far as they go. They don't really throw out a curriculum or some like give a rough sketch. And so I'm here to give you what I think is going to be the best for 1 hour. Just before I start, there's a couple ways you can get your financial education. Starting from the left-hand side of the screen, the most expensive but least amount of effort, where you sign up, you get a financial advisor that does most of the stuff for you. On down, some courses, online courses, books, and then finally blogs and forums. And that's all the way to free over there, but it requires the most amount of work. So I mostly got my stuff from the left two side of things, but there's nothing wrong with doing the right two. I'm looking at it like a patient. The right two side of things, but the left two are also reasonable, and we'll go through and try and determine who needs to get the financial advisor by the end of this talk. No financial lecture would be complete without a disclosure slide. I don't get any money from anyone besides Vanderbilt. I'm not a financial advisor. It's informational purposes only. Do your research before you change your investments or something. So, all right. 5 things we're going to talk about today. And let's see why that happened. I don't know. The 5 things that we're going to talk about are, we like 5 things in emergency medicine. Our past chair was a big proponent of always remembering the 5 things of everything, just so you have a framework to go through. So we're going to start off with a big bad debt. Then we'll talk about our savings, some retirement account basics, Vanderbilt specific retirement accounts, and then finally a little bit on home buying versus renting. All right, so debt. So most of these numbers I tried to update within the last year or two, but forgive me if they're not exactly up to date. But generally, about 75% of medical students will graduate medical school with debt. The average amount this year, was $235,000 in debt. I was lucky. I graduated with about $100,000 of debt. My wife had about $50,000 from her. She's a teacher. She got a master's, and I don't know how she would have paid that off if she didn't have a higher marry someone with a higher salary, because to pay off she was probably about $60,000 or something. That would have taken her a long time. But we had combined around $150,000 when we graduated, and we had to figure out how to pay this back because the money needs to get paid back. And so historically, there's been one big way, and that's just to pay it off through the loans. The first thing I'll say about debt, though, before we talk about repayment, is that you need to get good at not taking out more debt. There's a concept of being debt numb, which is the idea, and I'm sure everyone's at least thought about it, of what's a big deal if I take out another $5,000, $10,000, $20,000 for whatever, the car, vacation. I already $400,000 in debt. What's an extra $20,000? That is could be a very dangerous path to go down, because that money will not only add up, you do have to pay it back with interest, and it makes it harder to get out of this debt hole. Some people like to say, well, aren't there some good forms of debt, the good debt? And there are. Just as we are all took the pathway to go into medicine, we went into debt to learn how to become physicians. There is good debt to, mortgages to buy a reasonable sized house. But there's a lot of bad debt. So I'm not saying you can't take on debt, just really be cautious and don't have that mindset to go farther into debt for unnecessary reasons. If you look at the entire United States, the average U.S. credit card debt is $7,000. $7,000. And the interest rate, I haven't updated this number in a while, but they said it was 16%. That means people are paying $100 a month just to pay off the interest of their credit card, not even getting down to the actual principal of their credit card. And so it is a bad problem, at least for a lot of Americans, to get into credit card debt and not come out of it. Okay, going back to what I mentioned, there's 2 ways to pay it off. There used to be only the second pathway, but now we have public service loan forgiveness. This is, a pathway that if you work for 10 years, and we'll go through the requirements, that the debt will be forgiven at the end of 10 years. It's a very cool pathway. I have a couple ultrasound colleagues that I think 4 of them got forgiven in the last couple of years for a total of like $800,000. So it works, and that is a reasonable pathway. But I took the second pathway, where right when I got out of fellowship, I refinanced my loans and I paid it off as fast as humanly possible. One of the reasons was I wanted to go into community emergency medicine. Clearly, it did not work out very well since I'm back in academics. I did not like it. It is not as fun as they say it is. But I was going down that pathway, so I refinanced and paid it off as quickly as possible. And just a quick note, what is loan refinancing? A refinancing means you're basically usually going to a new lender. So if you have the government as, let's assume the government, sometimes they resell your loans, but say you have the government as your the person who loaned you money, you'd go to a new bank and say, hey, I want to take out $200,000 at a lower interest rate. Can you help me? And they'll look and they'll say, yeah, you're qualified. And that bank will pay off the government the $200,000. And now you'll have a new loan with this new bank at a lower interest rate. And that's the goal, to get a lower interest rate so you pay less interest. So that's loan refinancing. Public service loan forgiveness. So you have to even, before you go down this pathway, make sure that you qualify for it. So there's a couple requirements, and it's a little bit hard right now because I'm sure you guys know about the SAVE program and all these court battles and stuff. So I'm going to give you the high level overview. If you want to work in the community, you essentially can't do public service loan forgiveness. Okay, you have to work for either the government or usually an academic university hospital. There's some hospital employees. I wouldn't count on it though. Pretty much academics or government. You have to have direct loans, meaning they can't be the FFEL or Perkins loans. Or if you do have them, you have to consolidate them into a direct loan. You have to make 10 years of payments or 120 months. And you have to submit the annual certification form. I think now they're doing it automatic, so maybe that isn't exactly true anymore, to say your income for each year. And it's good to save these forms, so when you do apply at the 10-year mark, you have evidence of your income for each year. And you have to be enrolled in one of the 4 income-driven repayment plans. So again, I'm not going to go into the plans because they're a little bit in flux with the SAVE plan. If you want, the VUMC has a repayment plan comparison chart to go through all 4 of them. But hopefully next time I give this lecture, I'll have a little more information about the SAVE plan. When should you even consider it? Say, okay, I want to go into academics, but what should I look for? Well, public service loan forgiveness is better for people that have higher debt loads and longer residencies because you're working a longer time with a resident or fellow salary. Whereas refinancing your loans to get a lower interest rate and paying them off fast, it's probably better if you have a shorter residency or lower debt. And so for me, coming out of residency fellowship, $150,000, you can look up your, here, let me pull up the laser here since my laser pointer doesn't work. You can look up emergency medicine here, $352,000. Now, granted, there's some regional changes that you have to account for. And if you want to go into academics, just cut a quarter of that right off for the privilege of working with residents. But I joke, I do enjoy working with residents. But you are going to expect a lower salary when you work in academics. And so I said, you know what? I have $150,000. Maybe I'll make $300,000. My debt to income ratio was about 0.5, meaning I had less your annual income compared to your debt. When your debt to income gets bigger, you want to think more public service loan forgiveness. So people that have $500,000 in debt and maybe are going into, pediatrics, that would be a debt to income ratio of like 2. And so you would take you a lot longer to pay that back if in that scenario. So you'll notice that plastic surgery is leading the pack here. Spine surgery is noticeably absent. I don't know why, but I just think that their bar doesn't fit on here, and that's why they left them off. I'm just saying, I don't know for sure though. But you can look at your specialty and kind of get an idea. And I feel really bad, for endocrinology and ID down here. You guys do important work, but you don't get reimbursed that well, and you're 6 years of residency and fellowship. So those are ones that you probably want to think more of public service loan forgiveness. Any questions so far, by the way? Sorry for all you budding endocrinologists or infectious disease people. I just ruined your day. Okay. They release stats every once in a while. And as of last year, 19,000 people got forgiven through public service loan forgiveness. It's probably over $2 billion right now, on average about $100,000 per person. Now, here's the important thing. 97% of applications were rejected. So you finished 120 payments, or you think you did, and you submitted your application to get your loans forgiven, and 97% of the time it gets rejected. Here are the reasons. Okay, 29% don't have enough payments. They just miscalculated or something. So yeah, they're not going to give you free money if you don't pay enough. 40% filled out the forms incorrectly. The government doesn't like that, so they're going to reject you. And the worst, most painful is you had the wrong loans. You paid for 10 years on the wrong loans, and you apply, and they're like, "Oh, actually, yours are not eligible for public service loan forgiveness." That would be like a devastating blow. But 31% of people had that. Okay, this is not as popular anymore, but for a while, people weren't sure if public service loan forgiveness was going to be around. They thought it was going to get rid of because it was too good to be true. And so they wanted some way to basically insure against this from going away. And so they created, or the concept is called a side fund. And so if you guys are concerned about it, that you can make a side fund. And what is this? So it doesn't take effect until once you're attending. But basically, if you're unsure, public service loan forgiveness won't be around. And this is probably unlikely. Most people think that if they get rid of it, they're going to grandfather everyone that has loans into it. Nothing's a guarantee, but probably. What you can do when you're attending is you stay in public service loan forgiveness. You calculate how much you would be paying if you went through that private refinancing. You obviously calculate how much you're paying now, and you find the difference of those two amounts. And whether it's $1,000 or $3,000, it's probably going to be a couple $1,000s. You put that off into a side fund, like usually like a bank account that earns, a couple percent interest, and you just put money into it every month. And so if public service loan forgiveness goes away, all of a sudden you have a bunch of money that you can just push towards your loans. And if public service loan forgiveness does not go away, now you'll just have a bunch of money in a savings account. So this is the concept of the side fund. Going on to the private refinancing, what I did, again, I wanted to go to the community. A lot of people, interest rates just decreased 2 weeks ago, so it's good to find out. Like I tried to update my slides about 1 week ago or 10 days ago after the rates decreased, but you can get interest rate for your loan refinancing around 4% right now. So if you guys don't know what you're paying right now in your student loans, it would be good to look it up so you can compare. If you find a rate that's greater than 1% difference, so if you're going from like a 7% to a 4%, that's 3% difference. That's a great savings. If you are going to go down the non-public service loan forgiveness pathway, I have no disclosures, but the White Coat Investor has about 8 companies that they like. I use one of them. They usually give you some money back as a bonus. They understand your residence, so you don't need to pay a lot in residency. So they make it pretty accommodating if you want to do it in residency. But I got 3 quotes, and I went with the cheapest one. So like I said, private refinancing, and just pay it back as quick as possible. All right. Again, feel free to interrupt with any questions. Savings. So the White Coat Investor always says you have to live like a resident, and to that I agree. For the next 3 to 5 years out of residency, and you don't have to live exactly like a resident, but live kind of like a resident. Because even if you finish residency and get an attending job, and you give yourself a 20% pay bump, you have now 20% more money to live on than you did in residency. That is a huge amount. That's like $20,000, almost $18,000. Again, I'm guessing. $18,000 more a year to go to concerts, go to travel more, whatever. That's a lot of money. And you can live a lot, your lifestyle expands, but you have a huge amount more income. And so you have to save at least 20% of your pre-tax income every year in order to retire on time. Too many older physicians don't do this, and they've run into trouble. This is talking about the financial literacy in medical education. They didn't have this. So there's a lot of physicians that are 55, 65, even in their 70s that don't have a big nest egg, don't have a big retirement. So taking the PGY1 salary at $70,000, you should save about $14,000 a year. Now, I know that's not always possible for you guys, but that's a good lofty goal for residency. Attending hood, you have to do it, but at residency, it's good to try. And when I say save, what does that mean? Well, it can go to one of 3 places. It can either go to paying off your loans, you can put it in a retirement account, or you can put it in a savings account, which people call their nest egg or their emergency fund, to build up a bank account. No one knows what is going to be one of the most common questions is, which one should I do? I have, $5,000 extra. Which one should I put my money into? No one knows, because you can always look back at the stock market and say, oh, the stock market was really good this year. I should have put in the stock market, or it was bad this year. I should have put in a savings account. No one knows. If you do any one of those 3, you're good. And so Jim Dolly, that's a white coat investor, says that if you can't live and live well on 80% of a physician income, you have a spending problem, not an earning problem. I think that's very true. Supposedly, he tells this to residents and junior faculty, and they think it's funny. It's like a very obvious statement. And he tells it to mid-career and late-career physicians, and there's no one laughing. It is, people do not recognize how much money they spent through their life, and they don't have a big nest egg. This is Jim Dolly, by the way. He's trying to look like a doctor here, stereotypical doctor with his white coat and his stethoscope. He is an emergency medicine physician, so I wanted to put him a more stereotyped emergency medicine physician, looking goofy, doing something dangerous. So that's him. All right. Why is savings rate so important? Well, the more you save, the more, I don't want to say you can retire, the sooner you can retire, but the sooner you become financially independent. So saving 20% per year, and these, you guys might like argue with different, I mean, these are kind of just general numbers. If you save 20% per year, you can retire in about 30 years. So if you graduate residency at early 30s, you can retire around early 60s if everything goes as planned, or 60 or so. Whereas if you save higher, you can retire earlier. And when I was first graduated fellowship, I was like, very like white coat investor, save money. I was probably, I never actually calculated it, but I was over 50% savings. And I was, not because I wanted to retire early, but because I wanted, it's kind of almost like a game. And so I was saving a lot. And my wife is not a big saver. She's more of a spender. We balance each other out nicely. She was, wanted to stick more towards the 20 or 15% range. I want to save more to the 50% range. And so over time in we've come down probably to around the 30%-ish range. So a nice, they say that, big spender or people that have more spending often marry someone that is a little more of a saver, and they kind of balance each other out. All right. So some people have spending problems, and I would encourage you, if you do, to have a budget. I don't think some people would recommend budget for everyone. I don't think it's mandatory. I just think it's good to know where your money is going every month. So, every once in a while, look at your credit card statements. Just figure out how much money you're spending, especially if you want to use, Mint or Empower or some of these other online ones that automatically categorize your payments. So you have fixed costs, meaning costs that you can expect every month to be about the same. And that's going to be your taxes. So you have your federal income tax, and you have, we'll call it, this is basically your Social Security and Medicaid taxes. I did it for a single person in Tennessee. Housing and utilities, I guessed about $2,200. Car insurance, $700. Phone, life and disability insurance, $200, and then your 20% savings rate, if you actually do it, then it's $1,200. And so that means your variable costs, or the costs that you can kind of fluctuate that aren't fixed every month, are all the other stuff, groceries, restaurants, your subscriptions. And so there's not a lot of money left over for those things. And so what happens when you don't have enough money to go to the restaurant? Kind of take a little bit of money from that 20% savings and you put it towards the restaurants, which, isn't the worst thing in the world as a resident, but you can't be doing that as an attending because your salary is so high, you need to at least hit that 20% savings rate. Other options, you could get a roommate, get those, those housing prices down, or ride your bike to work. I don't know, take the bus. And so you can decrease your fixed costs if you want. But it's good to know your fixed and variable costs for each in general. All right, moving on to retirement accounts. So there are multiple different retirement accounts, but we're only going to talk about one of them today. We're going to be talking about the employer-sponsored plans, so the VUMC plans. So when I say VUMC retirement, I'm talking about our 403B. You can think of it as a 401k. They're almost exactly the same, except 403Bs are for academic hospitals and things, or academic jobs. So it almost has the same rules. So 403B, 401k, you can think of them as the same. There are non-government or employee-sponsored plans called your IRAs, or individual retirement accounts, that become very important once you graduate, but we're not going to talk about those today. So when you have your 403B VUMC, you have two options, essentially, two buckets. So you can either do the normal way, the traditional way, or the Roth way. And so what you have to know is that the government, it wants to get their money. They're going to tax you at some point. So do they tax you now when you put money in, or are they going to tax you later when you pull money out for retirement? So they're going to get their money, but you need to figure out when to pay them the taxes. For most people in residency, a Roth is going to be a better situation. Because if you think about it now, your tax rate is very low. It's actually quite low. It might feel like it's high, but it's very low relative to what it's going to be in the future. So you have a low tax rate. And I never like to predict, but like there's no way taxes can stay this low with our budget deficit. There's taxes have to go up in the future. Like it doesn't make any sense. I guess you could continue getting more debt, but at some point taxes are going to have to go up. So with the combination of those two things, it's good to pay taxes now on a small amount of money, not very small, but a smaller amount of money, and then take it out tax free when you're older, 60 years old. Versus the opposite, where you actually don't pay taxes now, which feels nice now, but then you get hit with the bigger tax bill in retirement. There are some people that are going through public service loan forgiveness that want to keep their income as low as possible. So they will do the traditional or pre-tax route. That is, I would say, uncommon. And if you're not sure, there are a couple companies you can go through, again, White Coat Investor, that will actually pay them a couple $100 and they will calculate like all the variables to figure out which is the best pathway. It's usually for people that are married to high income earners in general. So if you're single, it's probably going to be a Roth. And the contribution limit's pretty high. You're not going to have to worry about it in residency. It's $23,000 a year. But in attending hood, that actually $23,000 is not nearly enough. So that's where some kind of advanced financial tricks, not tricks, that sounds bad. Financial education is helpful. Well, we all want to invest in a very evidence-based manner. We like to be evidence-based physicians. So let's be evidence-based investors. They show that if you invest in a low-cost, broadly diversified index fund, you are going to beat the market, beat most people with MBAs and a lot of computers and a lot of salaries almost every time. Almost every time. There's a great story of Warren Buffett, one of the greatest investors of all time. 15-ish years ago, he bet a hedge fund that he could beat them by investing in the one just index fund called the S&P 500, and wouldn't just put money in there. And then they could do whatever they wanted. They could play it however they wanted for 10 years, and who would come out on the top? And guess what? Warren Buffett not only beat him, crushed all 5 of their funds. And so he won, basically he just donated all his money to charity that he won. But it's just a powerful example of how actually investing in a low-cost, broadly diversified index fund can beat all these active funds where people are buying and selling and MBAs are thinking that they could beat the market. So what does low cost mean? Low cost means a low expense ratio. The expense ratio is how they charge you to invest in an investment. So it's a percentage. So usually we like to say low cost is less than 0.2%. So that's $20 for every $10,000 invested every year. But you can get ones even less than that. And I'll show you ones that are 0.02%. And so low cost, you want to broadly diversify. So you want to minimize your risk or spread out, diversify. So the S&P 500 is kind of the classic one. This is the fund of the 500 biggest companies in the United States. There are other funds like the Total Stock Market Index Fund, which has 3,600 stocks. The funny thing is, since they're weighted based on how big the company is, the S&P 500 and the total stock market are like exactly the same, because those other 3,000 companies are weighted so small that it doesn't really make a difference. If you could think of just the big 5 companies, Apple and Google, Alphabet and whatever, you can think Nvidia, Apple. I already said Apple. They are already like the juggernauts, so they move the market. They move the S&P 500 more than anyone else. And an index fund, what is that? That's a collection of stocks that track a financial market. So most of the time, people, again, we use the S&P 500. There are a couple other ones like the Dow Jones or the NASDAQ, but S&P 500 is what I'm going to refer to most here. So this is just kind of a visual representation of what buying an S&P 500 stock is. If you only have $425 to invest, you could buy some Nike, you could buy some Facebook, which is actually now Meta, or you could diversify over 500 different companies for that same amount of price. You just own a little bit less of each of those stocks. So same cost, more diversification, less risk. This is going to make some financial people cringe when I say this, but how to think of stocks and bonds, because you need to have, or at least people often talk about stocks and bonds. You can think of a stock as not actually what a stock is, but the concept of it is a more risky investment that has a greater potential reward, and bonds is a less risk, lower potential reward investment. Now I know that is not what a stock is, but you can think of it. So when people talk about stocks and bonds, you can think of it in that manner. And so you need to be aggressive at investing early in your career. How aggressive is up to you. Some people go 100% stocks and 0 bonds. That's as aggressive as you can get, essentially. All the way down to, I wouldn't recommend 50% stocks, 50% bonds, just because early in your career, you can suffer a bigger loss and make up for it. Whereas you coast into retirement, you don't want to suffer a 50% loss on your retirement. So you need to get more bonds as you get older. But as of right now, early career, at myself right now, I used to be 100% stocks. Now I'm about 90% stocks, 8% real estate, 2% bonds. So I'm still a pretty aggressive position at 41. So, but what some people say is invest as much in your portfolio to the stock market as you can tolerate without selling in a stock market. Because what happens in a stock market is you see your portfolio go down and you're like, oh my God, I need to get out of this now. And you sell, and that is the worst possible time to sell. So here's an example of the S&P 500 since its inception in the 20s, I believe, and all the way up to 2023. And what is your takeaway here? It goes up. It's always going up. Well, when I say always, I mean, if you take any 30-year time span, the length of your career, it's always going to be above the position before it. Except people will always point out, oh, well, there's this whole the great crash of 1929 where you lost 90% of your portfolio, which is terrible, and it took about 25 years to come back up to its position. So yeah, that was an outlier. That was pretty bad. But short of that, every other little dip usually was gone by a couple months or a year or two. Even the stock market crash of 2009, which was this one right here, looked like it was horrible, but look at by 2023, I mean, raging on. Oh, and I should mention, this is done in a log fashion, so you can get a better idea of how much money was lost. This is not actually a dollar to dollar comparison, like a dollar, because in 1929, it would look like the price would be so small you wouldn't be able to see it. So, when the stock market goes down, you should actually buy more. If the stock market's down 50%, unless you actually fear for the solvency of the U.S. government, you think that the government's not going to repay its loans, and you think the economy is going to heck, and you think that basically our economy is going to break, you should buy more. Otherwise, you probably have bigger problems, and you probably should focus on other things in your life. Here's another graphical representation. So a bull market is one where you're making money, essentially. A bear market is one where you're losing money. And you can tell that the bull markets are more frequent and they're in greater volume than the bear market. So yes, stocks do go down, but overall stocks are going up in the long run. Again, we're not day trading, so we're in this for the long haul. And this is just kind of a funny schematic of how people think investing psychology, where at the peak of when things are the most expensive, people are elated, but it's actually the highest financial risk. And then people sell down here because they're like, oh, this is terrible, and this is actually the best time for investing. I won't go into investing psychology, but that's kind of the idea. At Vanderbilt, you have around 23 options. Last time I checked, I want to introduce you the Target Date Fund and then some other funds, 2 other funds. So Target Date Fund. If you guys have ever pulled up your Fidelity accounts, you'll see that there's 11 target date funds where you can invest in basically a fund that predicts, you guess what year you're going to retire, like 2060. And you say, I'm going to put my money in there. And what the fund does is over time, gradually rebalances. So it gets more and more bonds over the course of your career. And so when you are about to retire, you're at less risk. And so they rebalance it every year for you, which is nice and it's convenient. And their expense ratio is pretty small, 0.08%. However, if again you want to be more aggressive like I am, You don't have to be, but is an S&P 500 index fund. It has its smallest expense ratio at 0.02%. It's just the S&P 500. There's no bonds in it. And then there is a separate bond fund as well. Again, just a low cost, broadly diversified bond fund. So those are two options here. And this is what it looks like when you go into it. Not that, but that. So target date funds are on top usually. You can see the S&P 500. They name it all these crazy names because it's not very obvious. So Vanguard Institutional Index Investor Plus Fund, the VIIX. Great name. So that's the S&P 500 fund that I have essentially most of my money in. Is this going out a lot? Should I? This is generally, you can look up stocks, but here's what I want to focus on. Expense ratio. If you're ever not sure, you can look up the cost of the fund right here by the expense ratio. All right, as someone mentioned in the back, retirement at Vanderbilt. So starting second year and later, Vanderbilt makes you put in money into retirement. They take 3% of your income and put it into Fidelity for retirement. The great news is they match that 3%, which is nice. So they will give you some additional money. And then there's an optional 2% match. I would say that it used to be not well known about. I'd say that it's pretty well known about now. Is anyone that, I don't think anyone wants to raise their hand, but did anyone not know about the 2% optional match? Or just find out about it? Basically, if you put in 2% extra of your income, Vanderbilt will match it 1-to-1. And so you will basically get, if you throw out the R2 salary, which I updated, $72,000, you put it the mandatory, and then there's an optional. And so now you're getting an extra $7,000 into retirement, and you're only paying half of it to get that amount. So you should be taking advantage of that 2% match, unless you're paying off like credit card debt to get out of, because that's a high interest debt. But everything else, almost always you should be taking the match, unless you have a very good reason why you shouldn't be. And then Roth, you should be doing that. For my last topic, this one's a little bit shorter. It's just the concept of buying a house versus renting a house or an apartment. Everyone that finishes residency wants to buy, I should say medical school, wants to buy a house. There's something comforting about buying a house. It's an American dream, and I don't know, people like it. So in general, unless your residency is pretty long, residency plus fellowship, I should say, is over 5 years, it's probably not going to appreciate enough to pay itself off, to pay off all the fees associated with it. Of course, if you invest in a hot market like Nashville, if you got in early, of course, that is an exception. But in general, you're going to want to rent during residency. The reason is there's three big reasons. One is that you just don't want to deal with owning a house. I didn't know how much home ownership, how many things break, and how many things you have to pay for. It's painful, and like in residency, you just want to like do your job. And so like when things break, you don't want to deal with it. And it's great at an apartment complex, just call it maintenance. New home buyers also underestimate the cost of home ownership. There's a lot of unknown things that come with it, sometimes lawn care and whatever, insurance and this, that, and the other, property taxes. And then finally, residents don't get a tax break for owning a home. For most, again, I'm speaking in generalities, but most residents don't get a tax break for owning a home. And you'll hear people saying, oh, renting is just throwing your money away. Well, it's not throwing your money away. You are paying money for a place to live for that month. That seems like a very reasonable exchange of money for opportunity. So you're not throwing money away. And then when you own a home, you're like, wait a minute, mortgage interest, insurance, property taxes, maintenance, realtor fees. You're like, that's throwing money away. So it's like the grass is always greener. There's always things that you think you're throwing the money away on. So the suggestion is don't buy a house until you are both financially and your social situation and your job are in a stable position. I rented right after fellowship. I'm glad I did because I thought I got my dream job in the community. It wasn't, as I mentioned earlier. So I was renting. It was very nice at the end of that year to throw the keys back to my apartment complex and say, I'm out of here. I'm going, I'm leaving, instead of having to get the house ready to sell. And so in general, you want to keep your mortgage less than 2 times your gross income. So if you make about $200,000 a year, this probably needs to be edited because salaries are going up a little bit, and you want to live in a $500,000 house. These numbers are a little unreasonable for Nashville. You'd want to have $100,000 down payment to get that mortgage. Now, I'm saying that, but I'm also kind of lying because I got a physician loan on my first home purchase, and I paid 0% down. But it was at a low rate, and everything was, all my ducks were in a row. So I actually had 0 down for my physician mortgage. The other thing to think about is when you're comparing rent to mortgage, don't compare it 1-to-1. $2,000 rent is not comparable to a $2,000 mortgage. Okay, you have to account for like all those taxes and fees that I mentioned earlier. So a $2,000 rent is really like a $1,400 mortgage plus a bunch of other fees thrown on top of it. So you can't afford a $2,000 mortgage a month. You have to account for all the fees. I do recommend to read a couple books while you're in residency and beyond. People bring up the topic or the idea of a $2 million book, and I will tell you the White Coat Investor, the OG White Coat Investor book on the left is definitely a $2 million book. What is that? That's to say, if someone said, I'm going to give you $2 million in retirement to read this book, would you read it? Most of you would buy the book today and read it by tomorrow. Like that's like a for sure thing. But no one's going to do that. So the concept is that this book got me interested in personal finance and totally changed my idea of personal finance. And I'm sure it's going to be at least a $2 million book for myself. So I love the original White Coat Investor. Can I have a show of hands who's read it? All right, pretty good. About a third of people. Physician Philosopher is good. The second, or what I call the advanced White Coat Investor book, which is the third book right there, is really good. It gives you a 12-step way to get your finances in order. Again, I have no conflicts here. But basically, you read the first chapter and it says, okay, disability insurance. This is what it is. This is why you need it. This is how much you need. This is how you buy it. Go buy it and don't read any more of the book until you bought it and come back. And then you come back to the book and it's like life insurance. And it does the same thing over and over again until all 12 steps are satisfied and your financial life is straight. Yes. But it really is very good. And then finally, A Simple Path to Wealth. I really like this book. It is a book that manages to not only give you a really actionable information, but also gives you a good philosophy about money. So do you need a financial advisor? I don't have one. Many of my friends don't have one. I don't think you need one. If and only if you're willing to spend a couple hours on your finances, looking at maybe some statements, looking at how much you're spending, reading a couple books, you need to put a little bit of time towards this. If you don't want to, that's fine. Here's the test. Here's the test if you want to figure out if you need a financial advisor. There is a 14-page free ebook right here called If You Can by William Bernstein. He is a physician. He was actually a neurologist who retired to become a kind of a prominent financial guy. And he wrote this book. It's for free. And if you can get through a kind of a dense 14-page book or like a little bit longer 14-page book, and you can understand it, then you probably don't need a financial advisor. If you're like, I don't want to read that, you probably need one. And if you don't want to, that's fine. We mentioned it earlier. It's fine. But you want to get a financial advisor that does not charge by a percent of how much they're managing for you. So if you have someone that's charging you 1% of your portfolio every year, that adds up to a massive amount over 30 years. It could be, again, with some reasonable numbers thrown in there, over $500,000 over 30 years that you'd be paying to a financial advisor. So get someone that charges $150, $100, $200 an hour, pay them for a couple hours, which I know hurts to pay $1,000. And do that every year and to get your finances in order. And you get a fixed fee financial advisor. Okay, and this is my last slide before the summary. You can't see here. This is to show that the relationship between money and problems. This was a landmark economic theory. Does anyone know who the economist was on this? It was the notorious BIG, Mo Money, Mo Problems. This is to show money isn't the answer to everything. Obviously that unforeseen problems arise when you get more money. I'm like right here. So I've got the amount of problems that arise when you get more money is surprising. But money is not the end all be all. I don't want you to leave here thinking that that's your number one goal. It's a tool. Money's a tool that you can use to, buy experiences, buy stuff, buy downtime, buy back your time from work. And I want you guys to know how to manage it, but not focus on it heavily, or at least all your time on it. And so my summary, 5 core summary things. You got to save 20% of your pre-tax income for retirement. You want to invest money in a broadly diversified, low-cost index fund. Try to rent until your personal and professional life are stable. You want to minimize debt, or at least don't become debt numb. And then read a few financial books in residency and beyond. My email address is up here. If you want to send me an email, I'm always happy to answer. Slides are on the QR code.